here for Grant Thornton. Today I'm joined by Holly Stiles from our Corporate Finance service line, Paul Gooley, our Head of Corporate Finance, and Adam Alexander, a partner in our taxation practice. We're here today to talk about health and aged care and what the budget is bringing for our clients and for those in the sector that need some support as we go forward. Today I'll talk a few moments to talk about general matters in the budget, and then we will specifically talk about aged care, given the high level of impact that the Royal Commission's had on the sector over the last few years. It's great to see that the government is committing to more funding for schools, hospitals, the PBS and mental health. The NDIS is receiving about $13.2 billion over 4 years to assist that program, and we'll see the program move through to maturity. Aged care is getting an investment of about $17.7 billion. This is really interesting because it is mostly tied up in 80,000 new home care packages. Those home care packages will be delivered over the next few years to eliminate the wait list. I'm going to hand over to Holly because we see that there is going to be significant more mergers and acquisition activity. And I've invited Holly along to our session today as her experience in other sectors is really relevant to what we're going to see in the aged care sector in the next few years. Holly, have you got any insights from your experience in other sectors that will assist us in the aged care or assist providers in aged care?
Yeah, sure, Daryl. So we definitely saw Saeed mention in the initial session the increased level of M&A activity at the moment. So that M&A activity is active across a lot of sectors, but he particularly called out the health sector, so adjacent to aged care. And we're certainly seeing a lot of activity in that sector, driven by very similar trends that would apply to aged care. So the ageing population, the increased NDIS funding, just general focus on health and well-being. All of those trends are driving investor interest in the healthcare sector. And what we're seeing is that with that interest, we have a very fragmented sector. There's a lot of small players, and so that really provides the opportunity for investors to achieve a good return through consolidation. So we're seeing that consolidation activity happen over lots of different subsectors within the healthcare space. So we're seeing it with GP practices, with radiology, with dental, all kinds of other allied health providers, disability and health products, with mental health service providers and in-home care services as well. So there's lots of large corporates who are doing consolidation in those sectors, and also a number of private equity backed businesses who are doing what we call roll-ups, where they're acquiring lots of smaller practices. We've been working with clients both on the buy and the sell side in transactions across most of those subsectors, and we're seeing the really strong level of buyer interest in health businesses, and certainly seeing that valuation multiples have been rising over the last 6 to 12 months. So if we apply that sort of thought to the aged care sector, that's also a sector that is quite fragmented, has the same dynamics around obviously an aging population, and now more government funding being applied to that sector. So we would expect to see increasing levels of consolidation happen in the aged care space. Other themes happening, including the increasing level of regulation and as the response to the Royal Commission happens. That consolidation activity hasn't quite hit yet. I think COVID has put a bit of a pause on that, as well as trying to work out what the response to the Royal Commission is. But we think that things are starting to fall in place now, such that that level of consolidation will start to pick up.
Given that some providers will be considering selling their businesses or exiting the market, what sorts of things can they do to prepare for those sales?
Preparation is really, I think, the key point, Daryl. So very often we see people reactively respond to a circumstance that means that they need to sell the business. So that could be a positive outcome, such as an approach by an acquirer, and we're helping a lot of clients at the moment who are responding to approaches. That's definitely a key trend at the moment with the level of M&A activity, but often it's a negative situation. So it's financial distress in the business, it's a shareholder dispute, or the illness perhaps of a key individual, something like that, which happens, which drives a sale process. And where a business hasn't been prepared, that really means that the options for getting a sale away on the best terms are more limited. So what can people do to prepare? Well, really have a think about who is your most likely buyer, or I suppose if you're in the not-for-profit space, who would be the typical not-for-profit that you might think about merging with, and what is going to be most attractive for them, and what is going to be a key driver or decision maker in the attractiveness of your business to them. So what can you do to reduce risk? Having strong systems and procedures, having good quality financial information. Very often we see with smaller businesses, their financials really just not very robust, and that does cause problems during due diligence. So trying to address those sorts of housekeeping issues and improve the business practices is definitely a key thing. Making sure management's good and focusing on organizational culture is increasingly important these days. But then once you've done a bit of preparing for the actual business, then running a proper sale process where you drive competitive tension, where you're going to the right buyers, you're keeping them on the same timetable, you're presenting the business in the best possible light, you're getting that competitive tension that's most likely to give you a best outcome, and being prepared so you get through the due diligence process and able to get to a successful completion.
Yeah, I think that's great advice, Holly. Certainly we see transactions occur where that has been done, which give a favourable outcome, and less favourable outcome where people don't prepare. An announcement this last night was an additional funding for the Aged Care Quality and Safety Commission. They are looking to employ another 480 people and increase the number of visits from about 600 per year to 1,500 per year. That tells me that there's going to be a significant ramp up in the regulatory oversight of the whole sector. And that ramp up will more likely lead to increased sanctions, increased breaches of the standards being revealed, and potentially forced sales. Paul, you've been involved in some of those sales processes as a result of sanctions. Would you like to comment on what some of the specifics around those sorts of transactions are from an aged care perspective? On mute, Paul.
Sorry. Thanks, Daryl. And as you said, that change or that increase in workforce on the regulatory side will probably lead to further actions on sanctions. I mean, clearly during the COVID period, the regulators have been obviously focused on maintaining operational level performance at the facility. So there hasn't been as much action as we saw pre the pandemic. But clearly, yeah, we would expect that to probably ramp up given that extra workforce. I guess the most important thing around those sort of sales is obviously trying to resurrect the sanctions, or to fix the sanctions before it gets to that critical stage, because in those stages, once it gets to that stage, the process is very quick. It's a 4 to 6 week process that needs to occur, and there's a lot of pressure, and that can put pressure on valuation and completion risk as well. So clearly, it's obviously preferable to get on top of that early, and potentially, if it's foreseen that you cannot resolve those sanctions in the time required, then you look to market the business earlier on, I guess, as a prelude to going down the full sanction route. So that would be my advice, is really is once that occurs, is to look forward and work out whether you'll be able to resolve those in the time being. Otherwise, it will be subject to a very sharp process, which will tend to lead to a decrease in valuation.
And I think I'll pick up on Holly's point. Preparation. If you are considering a sale, or even if it's crossing your mind, because if you're in that forced sales circumstance that you talk about, Paul, there is no time to actually do much to increase the value or ensure that you get the best outcomes. That leads to, I've just received a question about the additional $10 per day in basic daily living fee. That $10 a day is being paid for the last few months. It's an extension of that program, and it will be paid potentially or essentially for hotelling services. So making sure that the food, the catering, the cleaning and laundry are all up to speed. Traditionally, and certainly for the last few years, providers have lost money on those services and subsidised it from other parts of their business. So the $10 a day, in my view, is really just an extension of viability, making sure that there are, or limit the possibility of market failures. It won't guarantee that, but it will actually certainly give providers some boost across the next 12 months or 2 years or so. Adam, from your perspective, you were involved in the development of our funding and finance report last year, very heavily involved. Are there any opportunities or any insights that you'd like to bring that the government hasn't considered or might consider in the future to assist the sector?
Yeah, thanks, Darryl, and good afternoon, everyone. I guess you could say that the budget was somewhat of a missed opportunity when it came to finance and funding. Disappointing, but also probably not that surprising, given that structural reform is really the first priority to be achieved or to focus on. But there are three aspects to financing and funding that are and will be critical going forward. And that's funding from the perspective of the providers themselves, the incoming residents, and potential investors, particularly given that we have a reasonable share of for-profit providers in the aged care space. And unfortunately, the budget really hasn't done anything in any of those areas for any of those three categories. So things like in the context of potential forced sales, the opportunity to look at stamp duty exemptions on a wholesale basis, or even stamp duty concessions around excluding RAD liabilities from purchase consideration. Things like payroll tax exemptions or concessions that might encourage even more so for-profit providers to come in and buy out distressed assets because they don't get the benefit of those as not-for-profits do. And there's a number of other funding methods using the tax and the superannuation system that they've really missed out on. The other thing I probably should note when it comes to financing and funding is that the aged care system in Australia is very unusual compared to most other industries, if you want to put it like that, in that there is a reasonable share of both for-profit and not-for-profit providers. And the tax and superannuation levers and other funding and finance methods that need to be used or considered vary significantly between those two categories. So part of what the government needs to think about going forward, and sooner rather than later, is how they can, to some extent, level the playing field between for-profit and not-for-profit providers, and make sure that there are a maximum number of strong providers who are available, capable, and willing to take out those providers who are struggling.
Yeah. Adam, I noticed that the outside of the commentary on the aged care sector, there was a provision for downsizers to invest more of the free funds from that downsizing process into their superannuation. Something that we called out last year. It's been dabbled with before. Have you any insights into that?
Yeah, look, I think obviously what they've done in this case is they've lowered the threshold from 65 to age 60, which means more people fall into it. Unfortunately, the big opportunity that's been lost there is to use that downsizer contribution, which is up to $300,000 per person, so say 600,000 for a couple, and potentially ring fence that or ring fence at least some of it for the specific purpose of entering into aged care or home care. At the moment, by going into superannuation, there are drawdown limits every year once a person enters into that that sort of pension phase. And that, of course, means that large sums of money are not available to those individuals to, for example, to pay RADs and the like. If it was to be ring-fenced or to have a separate pool for aged care, that would go a long way towards increasing the proportion of potential customers in the market who are able to enter on a user pays basis.
Yeah, thanks, Adam. Given what we've just been talking about, Paul and Holly, what do you think and we're talking about transactionals here, what do you think the implications are for valuations of aged care businesses at the moment, both from a home care and a residential care perspective, or combined businesses? Holly, I might throw to you just at a high level, or Paul.
I'll let Paul respond to that one.
Yeah, I can respond to that. I mean, I guess it's been a very stagnant M&A period, I guess, since the pandemic began, clearly, but also that was sort of a trend post the Royal Commission as well. A lot of processes were put on hold, and there was a lot of uncertainty waiting for the outcomes of the Royal Commission. So we've really had a fairly stagnant M&A market for a while, and valuations are obviously really came off, and that on the public markets really came off at the pandemic, down 70%, and have slowly got back to probably almost back to the levels they were pre-COVID, but still a long way short of where they were pre-Royal Commission commencing. So valuations are back. If you look at the listeds, they're probably trading at the low 100,000s of a bed, excluding RADs, which is still low. And if you take that back to private operators, we're probably we're well under $100,000 per bed valuation. So valuations haven't recovered, and I think if you look at the opportunities for valuations to recover, we're not going to see, even with the $10 per bed, we're not going to see major changes in terms of operational profitability. And if anything, expense increases are still going to outweigh that, particularly on the wage side. So I don't foresee we're going to get improvements in operational, and there's not as much RAD arbitrage as there used to be in terms of development arbitrage on the RAD book, because as we've seen over the last 3 to 5 years, DAPs have become more part of the mix, and so there's not that sort of underlying arbitrage that operators could do in terms of developing the RAD book. So I think valuations will still come under pressure. I think the regulation side is not going to help that. So really where we're going to see a lot of volume is where people have underperforming assets and will need to transfer value on those and transfer ownership, rather than running a hot market. The two offers from Calvary and from Soul Patts late last year have given the listeds a big boost in valuation, bringing them back to the current levels, but they were well underpriced there, and that's more again, market activity driving value rather than the core underlying value being driven by the fundamentals. So I still think valuations are under pressure and likely to stay that way for the foreseeable future.
Yeah, I think there's two things there. When you talk about margin compression as a result of the $10 a day won't necessarily relate to increased EBITDA, but the other initiatives, the 200 minutes a day minimum care, incentives for retaining nurses in the aged care sector, etc., will flow straight through to workforce. So that's not going to actually contribute to an increase in margin either. So there's some good things in there that will actually help workforce, but I don't think that's going to create necessarily an impact in valuation, for example. The second thing is, anecdotally, we're hearing from traditional purchasers of loose assets or assets that are for sale. They're getting far more choosy because their ability to absorb facilities on an ongoing basis is getting more and more limited from a management overhead perspective and how they relate to that. And also, they're really only buying those ones that they can back as winners. They will not take the risk that they perhaps would have 2 or 3 years ago. And I think that's going to have an impact on valuation as well. The question around digitisation of aged care and investments in the budget, there's nothing specific that I've come across at the moment. There are broader initiatives in telehealth and also in digital communications, etc. I don't think some of those the telehealth will certainly help aged care providers and residents, but I don't think some of the other digital incentives, particularly around the patent boxing, etc., are going to necessarily directly result in advantages for providers at this stage. The question also around wages, we've got an $80,000 in home care packages that have been announced. Quick calculation says that could need about 196,000 employees. That's not full-time employees, it's just people. And of that 196,000, up to somewhere in the vicinity of 10,000 nurses will be required around Australia. At the moment, providers are really struggling to get workers to deliver home care packages or to work in the aged care sector. I'm not sure that the budget hasn't delivered anything that's going to incentivise people coming in. We've got 33,000 carers places for training. That is fantastic and a great investment by the government. Again, finding people to put into those training places is going to be a significant challenge. And I think the government's looking at the sector to answer that problem or resolve that problem. I don't think that they've got a solution that will actually assist providers. And that will, I think, continue to impact margins, Paul, and potentially valuations, because if we want more workers, we're going to have to pay more, and we're going to have to compete with the disability and health sectors more broadly that pays about $5 to $8 an hour more than what the aged care sector does for a personal care worker. It's a significant challenge and it will be ongoing. We're getting close to time. I might just throw around to each of you just for some closing comments. Adam, from your perspective around funding?
Yeah, I think the main thing here is that there probably was, as I said, an opportunity lost in the budget to start thinking about financing and funding. But as I also said, I'm not overly surprised because there's bigger things to deal with first. I would like to see this become a discussion and sitting on both sides in terms of my advisory capacity with not-for-profits and for-profits. It can't be a one-size-fits-all strategy. Both of those need to be considered and their specific issues. Otherwise, any reform won't work, or it will unfairly potentially disadvantage one group over another. So we need to get it on the agenda and we need to start the discussion so that we can get things underway ASAP.
Yeah. Holly?
Yeah, so I think if you're in the health space, it's a very seller-friendly market at the moment. So maybe now is a good time to be thinking about your plans as a business owner and whether you may want to bring forward that decision to exit the business, because as I said, it's very buyer-friendly at the moment. Valuations are very strong. There's a lot of investor interest. If you're in the aged care space, we've flagged increasing consolidation in that sector. So perhaps it's time to think whether you're going to be a consolidator or one of the businesses who will be consolidated, and how do you prepare for that process either way. If you are going to be a consolidator, funding is relatively cheap at the moment, of course. So again, now is perhaps a good time for growth, and there will be certainly players who are going to need to be acquired. So yeah, time to get ready in either event.
Yeah, and I think in the sector there's a focus on the negativity around the number of providers who aren't making money, but more than 50% of providers are making money. So if you are a provider and you think you might be selling for any reason in the near future, focusing on your operational performance, getting the standards right, getting the clinical governance right, making sure your business is fit for sale one way or another, I think is an absolute priority. I think you need to start yesterday, and whether it's to try and sell at best enterprise value or and return yourself to profitability as quickly as you possibly can. And we're aware of a number of the businesses around that, and some of our clients that have returned to profitability. They've focused on business improvements and cost management, as well as revenue optimisation. So there's certainly opportunity to do things in the sector. Paul, your views?
Yeah, I guess back on that theme of let's keep it positive towards the end. I guess at least we've had obviously the Royal Commission, and some of that's been acted on, and there's further to come clearly. So we've got that some way out of the way, and also hopefully we've got the pandemic out of the way, including vaccinating the aged care population. So if you look at those, were two major headwinds to activity levels. So both of those are not so in the rear view mirror yet, but definitely people can assess the risks on those a lot better. So there will be consolidation. There will be opportunities for both buyers and sellers in the market. And as you said, Daryl, it's all about operational performance. Workforce is a big one for buyers, making sure we've got workforce and we can operate within our regulations. And then obviously trying to grow operational performance will be a key part to that. But there will be consolidation as players exit, and there'll be opportunities for people who have capital available. And as I said, valuations are quite historically low at the moment, and I foresee that will probably play out for the next 12, 18 months. So there will be opportunities to make some good acquisitions.
Yeah, and I'll note on the operational performance as well, $119 billion over 4 years committed to, and I quote Treasurer Frydenberg, restoring trust in the aged care sector. And to do that, providers need to respond. That $119 billion is for a number of things. One is an increase in regulatory oversight. Two is the development of infrastructure to support a new Aged Care Act, which will be developed over the next couple of years, and also supports in regional and remote areas. So regional and remote aged care providers will get some supports. That's a good thing, and I think that might actually create more opportunity for consolidation, or for those to be absorbed by larger organisations that can provide access to high levels of clinical support, etc. But that also tells me that increased regulation, increased oversight means that you've got to get your house in order. You've got to get focused on the operational improvements, making sure you're meeting the quality and safety standards and exceeding them where possible, and making sure you're ready any time that those quality and safety officers are walking through the door for your organisation. $17.7 billion in total, a significant investment by the government and very welcome in the sector. I think it falls short of what the sector would have liked to see, and therefore there is more opportunity for government to respond over time as the budget improves and the economy improves, to make sure that all older Australians receive the care that they need, when they need it, and where they need it. Thank you very much, everyone. I appreciate you signing in today. We will respond to all of the questions that we received. We couldn't deal with them throughout the course of the session, but we will respond to them to all registrants as soon as we can. Thank you very much. Daryl Price signing off.